Before we start, please subscribe to our YouTube channel for news and updates. Hello everyone. Markets traded cautiously last week, with the S&P 500 stuck in a narrow trading range since the start of July. The Nasdaq tech sector and growth factor outperformed, while value, low volatility, and equal weight traded lower. Small ended the week with a slight loss, underperforming the S&P 500. Overseas, emerging markets outperformed both developed markets and the S&P 500. In fixed income, rising treasury yields weighed on long-duration bonds, with the 30-year yield climbing sharply. Short-duration bonds were flat, as the front end of the yield curve held steady. Investment-grade corporate bonds underperformed due to their longer durations, while high-yield corporate ended the week flat despite modest spread widening. Gold was little changed, oil traded higher, Bitcoin set a record high early in the week, and the US dollar strengthened. Key takeaways: 1. Headline CPI rose plus 0.3% in June, pushing the year-over-year rate to plus 2.7%, the fastest pace since January. Prices for tariff-affected goods like sporting goods, so 1.4%, household furnishings, so 1.0%, and apparel, so 0.4%, rose as the first wave of tariffs filtered through to prices. Core CPI posted a more modest 0.2% increase. Shelter inflation contributed about one-third of the monthly gain, but continues to slow on a year-over-year basis, helping to offset price pressures in the goods category. Producer prices were flat in June, below the plus 0.2% consensus estimate. Within PPI, goods rose plus 0.3%, while services fell 0.1%. Implication? Inflation progress is slowing, but it's not reaccelerating. The data suggests that goods prices are rising because of tariffs, which will likely prevent the Fed from cutting rates in July. 2. Industrial production rose plus 0.3% in June, ending a two-month flat streak. Utilities output jumped plus 2.8% due to a heat wave and accounted for most of June's strength, while mining fell by 0.3% as oil and gas drilling declined for a third month. Industrial output expanded at a 1.1% annualized pace in Q2, a slowdown from Q1's plus 4.3%. Manufacturing rose by only plus 0.1%, held back by a 2.6% drop in auto production. Implication: June's industrial rebound was real but narrow, driven by weather and sector-specific gains rather than a broad increase. The moderate uptrend that started late last year is intact, but momentum is fading. 3. Retail sales rose plus 0.6% in June, rebounding from May's 0.9% decline. Gains were broad-based, led by autos, 1.2%, clothing, 0.9%, and building materials, 0.9%. Food services, 0.6%, and e-commerce, 0.4%, also contributed, while home furnishings, electronics, and furniture all fell by 0.1%. Control group retail sales, which feeds directly into GDP, rose plus 0.5%, but growth continues to gradually slow. Implication: June's report was better than expected and eases concerns that consumer spending is rolling over after two negative prints in April and May. 4. June's data point to a gradually cooling economy, but not weak enough to justify a July rate cut. Growth momentum has slowed in the labor market, consumer spending, and industrial production, which aligns with our U.S. business cycle indicators contraction reading. However, it's a gradual deceleration, and growth is still positive. At the same time, early signs of tariff-related price pressures are emerging. Implication: the Fed is likely to hold rates steady in July, with cuts later this year dependent on further inflation progress. Politics and concerns about Fed independence likely raise the bar for cuts, meaning it could take clear signs of weakness for the central bank to act. 5. Trade policy uncertainty remains elevated, but the market seems unconcerned. Implied volatility, which measures investor expectations for near-term market movements, has declined across stocks, bonds, gold, and currencies in recent months. The decline is an indication that investors expect calm, stable conditions in the near term, despite continued trade policy uncertainty. Implication: the market appears to be brushing off policy risks for now, but this calm could be tested if trade tensions re escalate. Stay calm, stay invested, and let us know if we can help. Visit MRAadvisory.com to learn more and schedule a conversation with one of our advisors. Thank you for listening. For additional information, please visit our website.